I am very excited about this next guest because every time I had him on the podcast, I could not get, you guys know how I push, that I just could not get the data I wanted. And then all of a sudden, I say, let me put you on stage at SaaS Open. And he says, well, we actually just had a big transaction. I'll come to SaaS Open. We'll talk about it. That's all I'm going to say. Please help me welcome to the stage Joe from Issuu. Joe, come on up. Good to see you, my friend. Thank you for the water. So I'm going to keep chatting while I ask you questions, and I'm going to grab my coffee while you make yourself comfortable.
First off,
go ahead.
Say, you should change the name of this conference to the Resilience Open, because all we're hearing about is like one experience of resilience after the next. It's sort of the core of these businesses. Anyway.
I also want to tell you guys, and Joe, I hope you don't mind me doing this, but we'll get to this later because conference is not always just about business, but he actually feels great. He just sounds terrible. We'll talk about that in a little bit. We'll let that be an open loop.
I have vocal cord nerve.
Joe, this is called an open loop and foreshadowing.
Just let it
sit. Let it sit. They'll pay attention. We'll get to it in about 4 minutes.
I know. To get to the point, you know.
This happened about a month ago. What did you do with Bending Spoons?
Yeah, so first of all, I should just say I'm no longer the CEO of Issuu. I was the CEO of Issuu for 11 and a half years, and we got acquired by Bending Spoons at the end of July. So is anyone familiar with Bending Spoons? So they're a company everyone in this room should know more about. They're Italian-based, and they are acquiring primarily product-led growth SaaS companies, but also doing more as well. They bought Evernote, Meetup. They just bought WeTransfer. They bought us as well. Hopin, yeah. And what they're doing is they're buying companies that have some pretty good scale, kind of revenue in the $25 to $200 million range, profitable or close to it, and then they go run them. They buy to own. It's not a PE firm. And we found them through some of their earlier acquisitions, and they were sort of always on my list of folks that we should be reaching out to at the time when we were ready to look at getting acquired.
We're going to get your backstory here, but I want everyone to understand what the end looks like. So this is sort of what the end looks like. And can we put a dollar value on the deal, or maybe a range on the ARR multiple?
Sure, we can. I can't give you specifics because you're never allowed to give specifics like this. But I've never given you anything, so I'm going to give you a good range here, which will be pretty good. So, you know, we did as a company, we're doing just north of 30 million in revenue, profitable, not very profitable, but sort of barely profitable, and we sold the company for 9 figures.
Yep. So fair to say like a 4 to 6x revenue multiple, something in that range.
Yeah, not 6. I mean, unless you're AI right now, you're not getting north of 5.
Okay.
I mean, there's all these companies, you know, given the stage of where Issuu was when we sold it in July, if we had sold it 2 years prior in 22, we would have gotten 2 to 3x what we got.
Why didn't you?
Because we weren't at the size we're at now. I mean, one of the things that when you're selling a company, it's important to understand our lane, right? So, and where the market is. So we could have held on and continued to grow and build Issuu for another 2 years and hope that the market comes back. But I think it's also important to understand where we are in the business, where we are in the opportunity cycle, and we felt like, you know, profitable, growing, north of 30 million in revenue, good business, huge number of really happy customers. We had 1 million free customers a year, marketers, content creators, 65,000 of them paying Issuu. And we had gotten some inbound interest, and once we got that inbound interest, we started talking to folks out in the market.
So here's what we're going to focus on over the next 14 minutes and 30 seconds. You know, going from 0 to a 9-figure exit, right? We're going to talk about how Joe used debt, how he scaled ARR across 3 key sort of story points, and then exiting, right? You paid your bankers how much to do the deal?
$2 million.
Over $2 million.
Little to over $2 million.
Over $2 million. Was it all cash or cash plus earn out, a mix?
Whole deal was all cash, no earnouts, We actually
just let it hang. So we'll talk about that.
Another hanging
and then that's good, right? And then we'll talk a little bit more about the lawyers and the process you did on the exit. So all that in the next 14 minutes. But let's talk about the product for a second. This is your homepage. This is what you do.
Yeah. So Issuu is this massive digital publishing platform, primarily catering to marketers to take their marketing content, collateral, sales materials, brochures, publications, a whole range of different documents, mostly created in using Figma, Adobe, or Canva, gets uploaded to Issuu. Issuu hosts it, transforms it into a range of assets. So you create one piece of content, and it can get transformed into a video and link enhanced paginated version, an article using AI, social post, whole range of different assets that can then be shared anywhere, embedded anywhere, and then provide a whole range of data and analytics around that content. We landed on this homepage about 2 years ago. We had our version of the purple homepage also.
Going all the way back, I just put the revenue graph up. First revenue is back, or launch was 2006. Is that about right?
Company launched 2007. Very slow revenue growth for the first 5 or 6 years. Focus initially was massive scale. So I joined the company in 2013, took over from a previous CEO. And up until that point, the focus has been go find anybody that's got a longer form, high quality PDF. Brochures, catalogs, marketing materials, magazines, publications, all that stuff. Get it into Issuu. Because from there, make it look great. Issuu launched like as the iPad was launching, right? So it was a different time. Make it look great, get lots of data, and then start to figure out what aspects of this are valuable to businesses and start to charge. And we really honed in on being a B2B company in that 2013, 2014 timeframe.
So you guys can see, again, the story here, just doubling down on this idea. It's not always like, $0 to $1 billion of revenue in 2 days. This is like...
Well, it is for most companies.
Yeah, it is for everybody else except you, right? But we all, look at this. That's 10 years of hustle before your first $5 million of revenue, right? And now we see it. We're seeing the big exit on LinkedIn. It's a great story, but it takes a decade, 2 decades almost of hustle, right, to get to this point. So you're scaling at this point. You come in as CEO in 2013. Should we dive deeper there? Was there a contention with founders and investors, and they brought you in, or what happened?
The company was founded in Denmark.
In where?
Denmark.
Denmark.
And the lead investor is a firm, one of the larger Scandinavian VCs.
Would they led the 2007 round for 10.3 million?
Yeah.
Okay. The bottom one?
Yes. Yeah. I don't think it was whatever. Yes.
This is wrong. It's Crunchbase's fault, not mine.
Yeah.
But
Crunchbase doesn't have everything, but it's close. I think it was a little less, actually.
Okay.
I think some of that 2007 was actually...
The point being the lead of that Series A is...
Yeah, Hardcore Capital. They also put the bulk of the rest in 2014 when I raised, and KDDI, the big Japanese telco, came in as part of that. There was a founding group of 5 people. They were doing a nice job of scaling use, but there's sort of 2 main growth opportunities. One was partnerships with content tech platforms in Silicon Valley primarily, Facebook, Pinterest, Adobe, ultimately later Canva, et cetera. And then the other was really an emphasis on revenue growth. And so they decided to go find a Silicon Valley seasoned person to come in and run the business. So I joined. They had actually gotten rid of the CEO 6 months before I joined, which was really great. Most times when there's a CEO switch, the board will bring in the new CEO and then say, hey, lucky you, you've got this previous CEO and you can have them do whatever you want. And even in the best circumstances, and often it's challenging, it's confusing because the people who are still in the company aren't sure where their loyalties are supposed to lie or who's really in charge or whatnot. So
what are the brass tacks here, though? So they got rid of the CEO because he wasn't performing or she wasn't selling, or what was the...
Didn't have any connections outside of Denmark.
Okay, so
and wasn't really growing the business.
Couldn't grow internationally.
Yeah.
They find you. Were you already involved in the company, or they brought you in from
No, they brought me in from scratch.
Okay, from scratch. You are a talented guy. You can do anything you want. How did they recruit you? What was your comp pack like? Did you get equity?
Yeah. So we flipped the company. First of all, we flipped the company from being a Danish company to a US company. That was a somewhat complicated process. I got a nice comp package. I'm not going to give you the specifics, but I got a much higher percent of the company than normally when you bring in a CEO.
Would a normal CEO be like 4 or 5%?
Yeah.
So you're higher than that.
Significantly higher than that.
Okay.
Nathan always asks these questions really fast, hoping that you'll answer them. But we've done this a lot, so but I'm giving you more today than.
You're great. I'm not complaining. This is wonderful. So you come in, you're well incentivized. You get the thing international.
But let me just finish on the point why I came in. So I've spent my career in this intersection around creativity, content, and technology growth. I was at a company called Virage back in the late 90s, early 2000s that did video search. I ran the business side of things at Flickr. So sort of my wheelhouse is content. And I loved the background and the basis and foundation of what Issuu is doing. So I was excited about the product. I thought, wow, I think there's a lot we can do here. Good comp package and exciting.
Yep. So you're in now full time. You're growing the business. You did this Series B. I want you to just quickly on what was the thinking in 2021 when you did this debt deal, and can you share the terms?
Yeah. So we were an unusual cap table. It's quite good. We had no preferences. When we flipped the company from being Danish to American, as part of a deal between me, the founders, and the investors, we agreed that everybody would be treated equally. So there were no preferences.
Just to be clear, there were only common shares of the company.
There were preferred shares, but they were treated the same as common.
It's all the same. Okay.
So what it meant is, when we got to a point where we wanted additional capital, raising money. So in 21, given where we were at a revenue and growth trajectory, 21, everybody was pushed to raise way more money than they wanted, at higher valuations than were reasonable, and we're seeing a lot of fallout from that now, right? So I wanted to make sure that we maintained our flexibility. So instead of raising, we would have had to raise $30 million on a $250 million valuation, which meant that for everyone to feel successful, we would have had to have $1 billion exit, which may have happened, but I wanted to make sure I maintained flexibility around things. Plus, we would have now had this big preference stack. So we got introduced to a lender, very highly recommended. We took on $20 million of debt, actually, and had access to another 10. So it was announced as 31, but it was really 20. I won't give you their name, but we've had 3 lenders in our history. One was SVB, where we took a very tiny amount of debt actually during that 2014 raise. And then the third one was a firm called Eastward Capital in Boston, who were absolutely fantastic to deal with. We ended up refinancing this 2021 lender with Eastward.
I want people to take the lessons you learned from that. I know you don't want to talk negatively, but this is important stuff. What went wrong about the first debt deal?
I don't want to talk negatively, but I will talk honestly. We worked with a firm who were really essentially predatory lenders. Lending has a bad rap. However, I think there are great lenders.
Joe, I got to hold on once. There's one piece of information they have to have. What was the interest rate on the first piece? It was
like 12-ish%.
So the reason I'm bringing that out is most of you wouldn't put the idea of predatory lender and 12% together. Most of you, if I told you, hey, what does a predatory lender charge? You're going to say something like 40%.
Okay.
Right? So now let's take the rest of the story.
Yeah. There's 2 forms of predatory. There's interest rates, and then there's process. So we raised $20 million of debt, again, so that there wouldn't be additional preferences, et cetera. And we used that money to power innovation, to power launching an enterprise product, and to start powering deep integrations with folks like Canva and Adobe. We used the money well. However, about a year into it, we missed our revenue covenant by a footfall. So on a $7 million quarter, we missed by about $150K.
So just to be clear, revenue covenant is going to see something like when you're sending a term loan, it's going to say as part of the compliance certificate and covenants, you must grow revenue by 10% year over year to remain compliant. Otherwise, we can call all the debt back to us. That would be a similar kind of covenant.
So we knew we would have to pay a penalty and increased interest. All that was fine. That wasn't the predatory part. Predatory part came in when we agreed verbally to change the covenant terms moving forward. And this firm continued to negotiate with us after we had verbally agreed and kept squeezing and adding in more and more and more and more terms to the point where they started to demand, they wanted at one point, an additional point in the company for each month that we didn't refinance the business, and wanted to charge us a penalty of $1 million if we didn't give them those 1% warrants within 3 days. Prior to all of that coming into play, we refinanced with Eastward Capital, who were fantastic, and we didn't end up having to pay much of those penalties. But anyway, through all of this, we continued to grow the business, brought on better and deeper integrations. I had a health scare, but we navigated through it.
Let me pull the story through now, right? So, and remember, 1 million, 1% of the company, they sold for 9 figures just recently. So every 1% penalty is paying on the company. If he even sold warrants on the debt deal, 2%. Well, if you sold for north of $100 million, that just the 2% warrants is $2 million right there. And then every extra 1%, that's another $1 million off the sale. I mean, right now, I mean, you got to calculate that into your cost of capital. I'm beating this down a little bit because it's self-serving. FounderPath is always more expensive on an interest rate level, but we never take warrants. And we never do these process tricks that put founders, like we don't charge a revenue growth covenant, for example, for this exact kind of reason.
The point of it is, like, we got through it and it didn't actually hurt the business, but it's a distraction, you know? And one of the things that I focus on as a CEO is CEO's main job is to limit distractions. That's it. We talk about CEOs and supposed to make sure there's money and all that stuff, of course. But if you don't have money, it's a distraction. So the key is limit as many distractions as you possibly can.
Yep.
So came through it, landed bending spoons, and
let me fast forward through this because I was gonna play a clip here, but I want to also be respectful and you name the firm in the clip on the podcast, and I don't want to create an awkward situation right now. But if people want to privately do their own research, they can go. But I will just say, in the moment when I interviewed you in 2021, right after you did the debt deal, you loved it.
Loved it.
You had no idea. I mean, oh, the rate is so cheap, Nathan. This is incredible.
It was great. They were a really highly recommended firm. And I'm happy to talk one-on-one afterwards. Or they're still running around trying to do debt financing. Don't work with them. Work with Eastward Capital or Nathan. Or there's a set of really good lenders. And debt financing can be a really positive thing for the business. But if you get in with the wrong folks, it's important to understand how to navigate out of it.
Over the last minute, Joe, I want to wrap up because there might be people in this room thinking, I actually do want to go sell to a private equity shop like a Bending Spoons or a Rocket Internet or one of these kinds of companies. So you get this deal done just recently. For those of you that joined late, over $100 million exit on $32 million of revenue. This is a company that is known for doing these kinds of deals. They've bought these other kinds of companies, which Joe mentioned. What should people be prepared for if they're entering an M&A process with a Bending Spoons? Lawyers, banking fees, process?
Yeah, so, you know, if you typically have a banker, that's a couple $1 million. Your lawyer, I think most people think, oh, I'll just get an M&A lawyer at the time I'm doing an M&A. Maybe your law firm does it. The lawyer you use makes a big difference. We worked with Goodwin Procter, Larry Chu. You know, when I talk about folks we work with, I try to be as honest as possible. Like, if they're not good, I'll tell you. If they're great, I'll tell you. Larry Chu is a fantastic lawyer at Goodwin, and he helped make phone calls and talk to people in the midst of this process that enabled us to navigate through both the term sheet and the contract way more efficiently than otherwise
Did the
would have done.
terms drastically change between term sheet signing and final?
No. One of the great things about working with Bending Spoons, they didn't retrade with us. I don't think they've retraded with others, meaning change the price. Terms were the terms. We agreed. There was lots of stuff that lawyers haggled over and things like that, but price was the price, and they were very high-quality folks to work with. And I think one of the things, as you're thinking about selling, that's really important is most of us, me included, think, oh, PEs will start to get interested in us, and there'll be, 5 to 20 strategics of some form or other, some quality or other, that we think can and should buy us. And I think all of us in the room, once you're north of 10, 15, 20 million, become attractive to PEs and strategics. And so, there's 50 Ps that could be interested, 20 strategics. But the truth is, in the moment that this starts to happen, the people that are interested start to winnow away fast because, if it's a strategic, Canva was one of the folks that could have and should have bought us potentially, but they had just bought Affinity.
Did they give you a term sheet?
We had really deep conversations with Canva and Adobe.
Okay.
Part of Bending Spoons was very good terms, really fast. And all cash. If I'd signed with Adobe, we'd still be negotiating, and I worked there for 4 more years.
Was the deal price though higher with Adobe? They would have all in been higher?
We were kind of around the same.
Okay. Yeah.
Some of the strategic may have been a little higher. Yeah. But my point is, many of the strategics that you think are going to buy you have something else going on. Either they're trying to get sold themselves if they're private. They might be buying something else. They may have just let someone go that's important. All kinds of things happen. Most companies, when they get acquired, there's 1 to 3 that really come to the table. So don't be disappointed if the 20 folks that you thought were going to buy you, that you thought were going to keep raising the price and quadrupling it, if that doesn't happen. It happens with AI companies. It happened with, a few here or there, but it's pretty rare. At the end of the day, there's 1 to 3 companies that are right for that time when you're ready to pull the trigger. You can stop and say, I'll wait 2 years or whatever. But
if you hang out in circles like this all the time, you would think the $100 million exit is the norm. It should happen every day. It's, of course that's what we want to do, but it is actually the rarity, right? Coming in 2013 at $4 million of revenue as CEO, scaling it to $32 million of revenue in a very competitive space. I won't name all the other companies, but very competitive space, and then running a successful process to get a all-cash 9-figure deal done, doing it all with vulnerability and transparency, working through debt deals, personal health scares as well. Got to give it up for this guy for being so vulnerable. Give it up for Joe from Issuu.
Thank you.
I appreciate you, man.
Yes,
that was awesome.
Thanks.
That was great.
All right.
We'll keep the slide.